Well, I wanted to welcome everybody here today to our call. I hope everybody gets something very useful and informative out of this today. I'm so excited that John is able to join us today. Just a little bit about John. John has been with Visionary for 4 years. He's been in the industry over 15 years now. As I mentioned in my email last week, John is Visionary's Chief Investment Officer. And so he has a lot of letters behind his name. I think one of the biggest sets of letters is the CFA, the Chartered Financial Analyst letters. So it's a big, big deal. And so I'm so happy that John is able to join us today. John is married to Kelly, has 2 great kids. And so, John, why don't we just jump right in today and get going?
Sounds great, Scott. Thanks for having me.
One of the things too, John, I wanted to talk about before we go to that first question is, I think it's important to understand that everything that we've just been through, and we talk about that, but clients have just continued to remain calm and understanding of what's going on with the coronavirus. And so as we get maybe into that first question, we talked to clients, last year, even first part of this year, going back to 2018, there's a recession coming. I just don't know when it's coming, right? So there's that recession coming. And then I'd always say, well, the economic numbers still look pretty good. Market numbers look pretty good, maybe a little overvalued right now, but things look good. And then so we go into February and March, and we get this raw, deep downturn, this blindsided us. And so let's just talk about that elephant in the room right now, this market decline that we went through in February and March.
Yeah, Scott. Everything felt great for 2019, right? Everyone was happy. As I remind people, it's really easy to be a good investor in 2019. It's really easy to be a good financial advisor. And if we're being honest, it's really easy to be a good chief investment officer in good times, right?
Yeah.
But certainly 2020 has dealt us a different set of cards. I think the reason why the decline in February and March felt so raw, blindsiding, was a couple of reasons. One, it was the fastest move from a new market high on February 19th to a bear market, which we would define as a 20% decline in history. So the fastest move from a peak to a bear market in history. So we fell, and we fell fast. Yeah. The second reason it felt so blindsiding was, if you go back to January time when everyone predicts what 2020 is going to look like, I would challenge you to try and find a forecast that even mentioned the coronavirus as a risk to the market, let alone a reason why we were going to go down, right? And no one saw this coming. But it's a good reminder that we oftentimes don't see it coming, right? When was the last time you heard about someone getting hit from a car that they saw coming from a quarter mile away? It just doesn't happen, right? Yeah. But as investors, our challenge is basically we have to stand on the side of the road and watch cars go by every day, and know that there's always going to be a risk that a car, 99% of the time, cars are going to stay on the road. But every once in a while, a car may come up on the curb and cause harm to us, right? Yeah. That is what it feels like, what being an investor is on a daily basis. Is you are taking risk, but we never quite know what risk is going to manifest itself to actually come up on the curb and hurt us. And so, it's a reminder that these types of declines, while normal, will always feel painful and blindsiding to a certain extent.
Yeah. No, that's a great point. So I think too, to kind of piggyback on some of that is, we were at, I think the Dow was at an all-time high on February 12th, and the S&P maybe February 19th or somewhere around there. So we went from this high to this low so quickly, and just walking through some of that.
Yeah. So, why was that? Why did we move so quickly? Why did we set records that we don't want to set, right? Is really kind of, I think, what people want to know. And I think there's a few reasons. First of all, on average, we see a correction, which is defined by a market decline of 10%. We see one of those on average about once a year. Yeah. We had not seen one in 14 months. So by that math, we were overdue to see a correction. The other thing is, if you look at S&P performance since Christmas of 2018 through February 19th, the S&P climbed by over 40% in just over 14 months. Think about this. On an average annual return, historically, the S&P has returned about 10%, and we got 40% in 14 months. And so the markets certainly had an element of being priced to perfection when we went into this. Now, no one could see a virus coming that would cause this downturn, but certainly the markets were priced to perfection before this started. Another reason why we saw the violent sell-off was we went from a place in the market of complacency to panic, right? Yeah. We first heard about this virus in Wuhan, China in late December, and yet the markets in the U.S. continued to make new market highs for 6 to 8 weeks later, all the way to February 19th. And all of a sudden, the week after February 19th, we saw a 15% decline in a single week. So the markets went from a status of ignoring this risk for 6 to 8 weeks to all of a sudden overcorrecting and going the opposite direction, right? Or waking up at least and realizing this is a significant risk to the marketplace. And so we went from complacency to panic very quickly. The other thing I always remind investors is that the market doesn't like bad news, but even worse than bad news is the market despises uncertainty.
Right. Yeah.
Because if I give you bad news, at least you can make a plan as to what you're going to do from here to get yourself out of that hole, to make things better, right? But when there's uncertainty as to how many infections are going to happen, as to how long this is going to last, and how long the economic shutdown is going to happen. People don't know, businesses don't know how to respond. And so that kind of uncertainty is what dictated that free fall in the marketplace that contributed to that. So when you put those all together, I think that market uncertainty, the price to perfection, and that move complacency to panic are all triggers of why we saw such a violent and record-setting sell-off.
Yeah, so we think about from those high highs of 34%. I think I put in my note to clients last week. It was like 33.79. So let's just call it 34% down, right? And then we've risen another 30% back up. And so we still have economic news that's not great. We still have uncertainty around reopening. We still have uncertainty around the virus. Is there going to be a vaccine? When is that vaccine going to happen? We have unemployment at least at 15%, probably much higher than that. So I guess just why do you see the markets responding so well now, up 30%?
Yeah, Scott, it's a really important question because it seems like it's climbing a wall of worry right now.
Yeah.
And I think it's a good reminder that the stock market is forward-looking. When it looks at valuations and looks at companies, it's looking at their forward, what they can bring in the future, right? What the economy can bring in the future. And right now, the economy, the stock market sees the U.S. economy starting to reopen. It sees the number of infections, the growth rate of that number of infections starting to decline. It sees our progress on treatments for the virus and a vaccine. It sees progress in that. It sees people still going back to work. And it sees unemployment eventually falling, right? And so it sees all these things that are helping in terms of what the market sees moving forward. And if you want any further proof that the market is forward-looking, think about this. We fell by 34%, between late February and late March, while we still technically had record low 3.5% unemployment. And record low in the past 50 years. We haven't seen 3.5% since 1969. And yet we still fell by 34% despite the economy doing well. And then what we found was, unemployment, as Scott, you mentioned, jumped. We lost 20.5 million jobs in April. Unemployment skyrocketed to above 15%. And what did the stock market do? So the stock market didn't wait for the economic numbers to get worse, for the stock market to fall. It also has not waited for the economic numbers to improve for the stock market to start to rise. Another point about why this market has recovered as it has, we talked about the April jobs number. 80% of the April job losses were furloughs or employers laying their people off temporarily.
Yeah.
And that's really important for two reasons. One, it tells you what businesses believe about this lack of demand recently. Businesses, if they thought this lack of demand was going to be long-term, they would have laid them off permanently, not temporarily.
Right. Yeah.
And so the fact that businesses, and by the way, the way businesses act matters to the economy, because the longer businesses shut down, the harder it is for them to ramp back up, and people can't consume if businesses are not open. The second reason why that furlough number is so important is if 80% of those 20.5 million jobs lost in April were furloughs, what it means also is that those people who lost their job will be able to get back on their feet and get back into their job sooner than if they lost their job permanently. And what we know is with the economy being 70% of the economy is made up by the consumer, by you, me, and everyone on the call consuming, is that those people who have lost their jobs, the sooner they start working again, the sooner the economy gets picked back up on its feet and can start to regain a level of normalcy.
Yeah.
So those furloughs have made the fact that those were temporary layoffs gives us confidence that the economy can recover sooner than later. And the final point I'll make on why we've seen the market climb so far over the last month plus is the government intervention, the stimulus, right? We've seen the Fed cut rates to 0%. We've seen the CARES Act, implement $2+ trillion of stimulus to the economy, to direct payments to people, beefing up unemployment benefits to those unemployed. And so the stock market's reaction has clearly illustrated that the market believes that this stimulus will provide a life raft, if you will, to bridge the gap until the economy can get back on its own feet.
Yeah, that's great. Yep, absolutely. It's certainly seems like Wall Street saw the light before Main Street completely has. So absolutely. Another thing that's come up, and we've seen a reprieve of this a little bit, but people go to the gas pump, right? And probably not as often as they did, 10 weeks ago, but they're going to the gas pump, right? And they're seeing gas, depending where you're at, $1.50, $1.80, $2 a gallon, which is significantly lower than they saw it 10, 12, 14 weeks ago. And so we see, gas prices are low. This is great. But yet we see OPEC and we see Saudi Arabia and Russia kind of feuding back and forth. And we see the fact that nobody's driving anymore, and we've got all this, nobody's flying anymore, this abundance of oil. But isn't cheap oil, cheap gas a good thing for the economy?
Yeah, Scott, it's a good question, because to your point, I've almost forgotten what a gas station looks like. It's been so long since I've been there, as I sit here in the comfort of my own home, and as do you. And the answer, like most things, is it depends. So to your point, lower gas prices are great for the consumer because they serve as tax breaks, right? Because you're not spending as much of your discretionary income at the gas station, it allows you to spend that money in other parts of the economy, which is a nice boost for the economy overall. The challenge is that if the price of oil drops too low, these oil companies have certain costs it takes to produce and refine that oil. So if the price of oil falls too far, those companies can no longer make money. And if they can't make money, then what happens then at some point is you start to see job layoffs, right? So if they can't make money, there's job layoffs. Those people are now unemployed, which hurts the economy. Those people who are now unemployed, they're surrounded by cities that support those jobs, right? So those people were going to bakeries, grocery stores, restaurants. All those places are now impacted by the fact that these people don't have jobs. And then what you also see is, these oil companies have investors, right? So banks that lend these oil companies are also harmed if they have to go bankrupt because oil prices are too low. And other investors who loan their money or shareholders are also impacted by this. And then you also consider there's so many different parts of our economy that are not considered energy sector, but their ability to operate is so important, is based on energy and the ability to have access to oil. And you see a correlation there, a domino effect of that other companies and other sectors are also affected when oil is too cheap. The last thing I'll mention on this is if you see bankrupts, in general, they reduce competition, which in the long run will actually cause prices to go higher. And in fact, that's part of what Russia's aim is to try and bankrupt some of the shale industry of the U.S. By putting this kind of pressure on them. And so in general, cheaper oil is good, but below a certain price, it becomes problematic for our economy. Because again, once we get out of this, most of us depend on our cars to be able to travel, to work. The ability to have access to oil is critical for our economy to function. So it's critical that industry is stable and has stability. And certainly you've seen the government echo those same comments in terms of their willingness to support it if need be.
Yeah, it's great. I think too that, one of the things I was thinking about and we've come through some of this, getting through February and March and even the first week or two of April. But what if, things go worse again and vaccines don't come as quickly as we think, or there's a spike someplace and someone says, hey, I'm thinking about going to cash. I need to go to cash. Let's move to cash. What are your thoughts there as far as what advice maybe would you give as far as should I go to cash, should I not go to cash?
Yeah, Scott, I think that's a good question, because we all have that feeling in our stomach when things go down, right? That makes us a little bit nervous.
Yeah.
And I think in those kind of times, And by the way, to the point of whether we'll go down again, my crystal ball's in the office, but right now I can't get in the office. So I'm going to have to, I can't tell you exactly what's going to happen.
That's right.
But at any rate, I think the best thing we can do is look at history and look at what we know. Historically, these types of pandemics have been short-lived, and stock markets tend to bounce back in relative short order. In the past, you've seen what they call V-shape recoveries, in the sense that you see a swift decline followed by a robust recovery. Now, just because that's happened in the past does not guarantee that we'll see that in this case. But as Mark Twain once said, history doesn't repeat itself, but it does rhyme. So I think there's a reasonable chance that we can use as a baseline for what we might see here. And maybe it's a little bit more prolonged than that. But again, it gives us some guidance, but no assurances as to what we're going to see. The other adage I heard long ago, but I've never forgotten, is that the stock market is like taking the escalator up and the elevator down. Which means when we go up, we generally go up slowly over time, but when we fall fast.
Yeah.
And I think personally, look, we all have emotions with our own money, right?
Right.
And that helps me remember that when the market falls, this is normal, and when it falls fast, this is what's gonna happen when it does that.
Yeah.
And so I think that kind of mentality helps me maintain a right long-term focus. Another fact I would share with you is that in the past 20 years, six of the 10 best days of the past 20 years have been around within 2 weeks of the worst days of the market. And so it's important to remind investors that if they want to try and jump out when the times are bad, they risk missing some of the best days. And certainly this recovery has shown that. We bottomed in the market on March 23rd, and March 24th brought us an 11% up day in the Dow, which was the best day in the Dow since the Great Depression. So the best day in 87 years. And then the week before Easter was actually in the S&P was the best week since 1974. And so I think it's important to remember that if you try and time the market, you risk missing the best days in the market. I'd also remind people when it comes to feel nervous, the dangers of trying to swerve and go to cash. The analogy I've always used is, you're driving down the road and a deer darts in front of your car, right? Your first inclination is to what, right?
To swerve. Yeah.
To swerve, right?
Yeah.
Well, if you go back to driving class, if you can remember that long, I have a hard time myself. They tell you not to swerve. And they tell you not to swerve for two reasons. One, by swerving, you actually increase your risk of harming yourself by swerving into oncoming traffic or a ditch or a pole. The other reason why they tell you not to swerve is that most times, if you stay on the road, you're not going to hit the deer anyways. And so it's a reminder for investors that if you try and get out and go to cash, we all know that timing the market is almost impossible to do. But if you're going to try and get out and go to cash, you don't have to do the impossible almost just once. You have to do it twice.
That's right.
Because you have to know when's the right time to get out of the market and when's the right time to get back into the market. Another point, Scott, I want to make on this topic about if you feel nervous and you want to go to cash is we all have a bias towards action, right? Not you or me or anyone on this call, but we all have friends who say, don't just stand there, do something, right?
Right.
John Bogle, one of the best investors, has done more for the individual investors than almost anyone else from Vanguard, famously said, most times in crises, 99% of the time, people will say, the propensity will be, don't just stand there, do something, when the actual proper course is, don't do something, just stand there. Yeah. Or if you're going to do something beneficial, right? Yeah. And there's research to back this up. I wrote about this in December of last year. It's on our website under news, under visionarywealthadvisors.com, about the bias towards action. This research piece looked at 300 plus penalty kicks of elite soccer goalies. And it looked at whether or not the goalie was best off diving left, staying in the middle, or doing nothing, or jumping right to try and stop the penalty kick. And what they found was that the best position for the goalie to give them the best chance of stopping the ball was to stand right in the middle. And Scott, I'll put you on the spot here. Do you remember what percentage of the time the goalie actually stood in the middle or did nothing?
I want to say it was very, very small chance, if not zero.
Yeah, it was 6% of the time. So the statistics showed the best position for the goalie, these elite goalies, was to stand in the middle to do nothing, and they only did that 6% of the time. And remember, these elite soccer goalies, first of all, they know what they're doing. They're elite. This is a elite class of soccer league that they researched. Second of all, they have all the right incentives to want to stop the ball, right? Personal pride, help the team win, work for their next contract, work for the next endorsement, right?
Yeah.
All these reasons that they have plenty of incentive to want to do the right thing. And yet despite that, their choice of diving left or right 94% of the time showed, well, why did they do that? Well, because if they dove, at least they could say, well, at least I tried, right?
Yeah.
And because they would feel, if they gave up a goal, they would feel better about trying than standing in the middle. So in other words, what these goalies did was they didn't make the decision that would optimize their chances of stopping the ball. They actually chose the decision that if they were going to fail, would cause them to feel less bad.
Yeah.
And so I think that message for investors is so important, because we all have that propensity. We have to do something.
You're right.
But it's important to realize that sometimes doing nothing is actually the best strategy that you can have. And certainly when it comes to investing, when times like these, that advice certainly holds true.
Yeah. Absolutely.
Scott, the one final thing I'll share on this is that we talked a little bit earlier about stock markets. They usually recover, almost always recover before the economy does.
Yeah.
So if you're an investor saying, I'm just going to wait for if we do go back down, and you say, I'm just going to wait until the economy recovers, let's look at the 08-09 recession as a great example. So the market bottomed. The S&P fell by 55% between, I think it was October of 07 to March of 09. The market bottomed on March 9th, 2009. We didn't end the recession until after the second quarter of 2009. So July 1st, if you will. Between March 9th of 2009 and July, the S&P was up by more than 30%, 36% in fact. Here's the thing. A recession is defined as 2 consecutive quarters of declining GDP growth. So how do you know that you're out of a recession? You need a positive quarter of GDP growth to
Right.
prove that you're out of the recession, right? So we didn't actually know that we're out of the recession until the end of the third quarter of 2009.
Yeah.
Between the bottom of March 9th till October 1st of 2009, the S&P was up 66%.
Yeah.
Now, those percentages are not important for this message because we have not fallen yet nearly that much. But what is important is that the stock market almost always recovers before the economy. So if you wait for the economy to improve to feel better about investing, there's a high chance you're going to lose out on a lot of opportunity.
Yeah.
Yeah.
It's great. John, the next question maybe to think about is, I feel like I'm a positive guy, half glass full kind of guy. If we were to use market terms, I'm more of a bull than a bear. And despite the market declines and the challenges that we've had, what opportunities or positives do you see coming out of this crisis?
Yeah, Scott, it's a good question. And I think there's reasons. It's always good to be optimistic. I think there's reasons why it's appropriate here too. First of all, when you look at the stock declines we saw in February and March, our bond portfolios, if you held in high quality bonds, they perform much better, flat to slightly positive during that time frame. And so we always talk when we have a portfolio of stocks and bonds, it's like a car, right? Stocks are our gas and bonds are our brake. And bonds serve their purpose as being that reducing that volatility of our portfolio, as serving the purpose of being the brakes for our portfolio during that time. And we know that the better those brakes are, the less our portfolio falls, which helps us stay in the market, stay invested. Those bond yields also, with the bond performance doing well, has also caused interest rates to fall. And those lower interest rates will actually serve as a catalyst for our economy on the recovery side. Because when you think about people, whether it's buying a house, buying a new car, home equity line, doing improvements, a lot of businesses deciding to expand their business, the lower interest rates are, the more it incentivizes businesses and consumers to spend. And so the fact that we've seen interest rates go so low should help be a catalyst for our economy to help speed up the recovery once we get on the other side of this. We talked about low interest rates. I don't like to use superlatives, Scott, when it comes to investing, because usually it comes back to bite you. But with 10-year Treasury below 1%, now may be the best time of the decade to refinance. If you look at how low interest rates are right now, whether it be a mortgage, a home equity line, a business loan, a student loan, or God forbid, credit card debt, rates are so low. Last year in 2019, rates weren't high by any means, but the 30-year fixed mortgage by Freddie Mac has fallen by more than 1% since January of 19.
Wow.
We bought a house in October of 19, in late February, I gave a call to our mortgage broker and said, hey, rates have fallen. When can I refinance? And in fact, they said that they would refinance without actually doing a technical refinance as a service to a new client. And we dropped our mortgage by $1,000 a year, I should say.
Yeah.
And there's very few guarantees in investments.
Yeah.
But if you can drop the rate of your interest payments, you are guaranteeing a reduced cost of that mortgage or of whatever that loan is for the life of the loan, right? And so as I was telling people, we've come back up, but my portfolio is down a lot more than that $1,000 we saved. The difference was I believe that my investment portfolio would recover over the long term, and those interest savings are going to be in my mind to keep. That $1,000 is not going to. I'm not going to be giving that up in the future, right? And so, I think that refinanced aspect is really valuable, and all it costs you is a call, right? Pick up the phone and call and say, does it make sense for me to refinance? It could save you a lot of money during these times. One other thing about silver linings, people might be asking, is now a good time to invest? Is this the bottom, right? And unfortunately, we already talked about it. I left my crystal ball in the office. But I think what's important is you ask the right questions. Scott, you nor me, nor anyone else really knows where the market bottom is or if we'll fall from here and how far.
Yeah.
Right. But I think the question you should be asking yourself is not, is this the bottom? Because perfection is the enemy of the good. The question you should be asking yourself is, am I going to be happy about do I think the chances are likely that I'll be happy putting money to work today in 5 or 10 years? Right? And if the answer to that is yes, then now is a good time to put money to work. If you look at let me get the date right. October 9th of 2007 was the day the market peaked before the Great Recession, before it fell by 55% over the next 18 months. Yeah. If you had invested in the S&P 500 on October 9th, 2007 and held for 12 years through last week, your average annualized return would have been 7+% per year.
Wow. That's great.
And that's investing on the worst day before the largest recession we've seen since the Great Depression.
Yeah.
And so I think it's really important for investors to realize that if you have a long-term time frame, we don't need to be too cute about, is this the right time to buy, right? And if you're worried about if markets are going to go lower, it's a great reason to say, let's do a dollar cost average, right? Let's put a little money to work the third Friday of this month, next month, and the following month, right?
Yeah.
Create a systematic plan so that you do it over time that's not geared to your emotions.
Yeah.
The final thing in terms of opportunity, Scott, I'll mention, and this may come up again, is Roth IRA conversions. And this is certainly something that you can speak to much better than I can, right? Is when stock market declines, the ability to take a pre-tax money and convert it to after-tax money, there's a tax bill associated with that. Well, when stocks are down, that tax bill is lower. And so it's something else to keep in your back pocket, whether it's a small part of your pre-tax money, but something else that you might be interested in taking advantage of if the market declines, especially for those investors who might be concerned about higher tax rates in the future with all this government spending.
Yeah. Yeah, a couple of points there, John, to make too. One on the refinancing. I've got lots of clients that are pharmacists, and they come out of St. Louis College of Pharmacy or SIU School of Pharmacy or wherever with all these student loans. And so we've had conversations with many of them about, hey, maybe take a look. Does it make sense for you to refinance some of that student loan debt right now? They come out with $100,000, $200,000, $250,000 of student loan debt from, St. Louis College of Pharmacy. Maybe it makes sense to refinance some of that. Maybe it doesn't, but that's something to look at while rates are really low right now. And as far as Roth IRA conversions, we've probably done at least 25 of these in the last 10 weeks. People have money sitting in IRAs. We reach out to them, say, hey, markets are low right now. It makes a lot of sense to go ahead and do this. And many of them have, I'd say most of them have done that. And taken the opportunity while the markets are lower to do that. And, I get the question sometimes, well, aren't I above the income limits on Roth IRA? So we have that discussion. Well, we're doing a backdoor Roth IRA, which is a way to do it. And we have that discussion on how we can do it still. And so I think it's, two great points there. Roth IRA conversions. It's in, even today as we sit here, even with the market up, whatever it was yesterday, the Dow 800 or 900 points, it still makes sense today to do Roth IRA conversions to get that money in the post-tax, the after-tax world. So, and if you have a home or you have student loans or something like that, you have a little higher interest rate. Maybe take a look. Does it make sense to go ahead and refinance? So I think those are great points to look at. Anything else to add there, John?
Not only, Scott, that you talked about when you have a couple $100,000 of a loan, whether it be a house or pharmacy school, it doesn't take much of a drop in interest rates to make it worth your while to look at refinancing.
Yeah, absolutely. So, another thing I think that you're great about talking about, and we hear is, kind of weary of these, our clients and investors and so on watching too much of this, what I call the financial press, right? Whether that's on TV with CNBC or Fox Business or Bloomberg or something online, many of these different publications that come out, maybe in the mail even still. So why do you think maybe that's risky for investors to pay too much attention to the, I'm going to call financial press?
Yeah, Scott, I think it's a really important question, something that has been really a personal agenda of mine to make people aware of. And not that the information is bad, but like anytime we do business with someone else, it's important to understand how that entity gets paid, right? And when you flip on a TV station with financial news, they get paid by advertising revenue, advertising money, which means, and by the way, why do people pay more advertising money? Because they have more people that watch their show, right? And so when it comes to a financial station, if they want to get more people to watch their show, how do they do that? What do they sell, right? And generally they sell two things, fear or greed. Right. And right now in this past, since you've seen this the last 3 months, they've been selling greed by the boatload. One of my two things I laugh at because I recognize it now is how many times they use the word plunge in the times between February 19th and March 24th to excite you, to grab your attention and your fear. Right. They choose their words and it's in big, bold letters. Right. And the other one is how often when markets are down, and you can pay attention to this to yourself, how often they quote the Dow as opposed to the S&P.
That's right.
Because a 3% decline in the Dow is a much larger number than a 3% decline in the S&P.
Yeah.
And so they're doing that because they know that larger numbers scare people more than smaller numbers. So they're going to quote the Dow, even though the Dow is 30 stocks and the S&P is 500 stocks in terms of comprising what the market looks like.
Yeah.
And so I think it's really important that you realize that. And why is this important? Because, I had an older sister when I was younger. She used to push my buttons and I just get so mad, right? But the minute that I realized what she was trying to do to me, and I had a better chance of controlling my emotions and say, I know what you're doing and I'm not gonna let you do anymore.
Yeah.
Right. And so that's the part where knowing what these news stations are trying to do gives you the ability to stop and say, you know what? I know you're trying to make me fearful. I know you're trying to get me emotional. I'm not gonna give up the control of my own emotions. So that's why I think it's so important that people understand how these stations get paid. Not that they're bad, but that you have to understand what their goal is.
John, we had another question that we had here was, what do you make of all these predictions by experts as to what stocks will do well, not do well as we come out of this economic halt?
Yeah, Scott, I think it's interesting because as we talked about earlier, 70% of the economy is the consumer. And I don't know about you, but my consumption habits have changed drastically over the past few months. So I would ask the question, well, Scott, your consumption habits before March were very different than your consumption habits in the last 2-3 months. Are you going to continue to do what your new habits right now? Or are you going to go back to your old habits?
Yeah, I mean, you'd think that many of us will adopt some of these newer habits.
Right. And you know what? We didn't rehearse this, right? That's exactly the case, is that it's likely that some people will keep some of the habits that they've adopted.
Yeah.
But you know what? I'm going back to restaurants. I really enjoy restaurants.
That's right. Yeah.
I'm going back to traveling.
Yeah.
But am I going to do more things with Zoom, and do more things with conference calls? Am I going to some of those expenses that weren't really giving me any value? Am I going to maybe change those? Absolutely. And so I think it's dangerous to say that this is how the economy is going to look like, or this stock is going to benefit, because we really don't know what consumers' habits will change back to the way they were, and what consumer habits will actually stay a little bit more to what they're doing now. And that's the challenge with trying to predict what sector will come out looking the best. The other thing that I always remind people when it comes to experts' predictions about these types of things, this is baseball season. Unfortunately, while we don't have any baseball going on, if you see a batter walk up to the plate, they always broadcast their batting average right next to their face, right here. So before they even take a swing, you have an idea of the probability of them getting a base hit, right?
Yeah.
Well, when was the last time that you ever saw a person on a financial news station give a prediction with their batting average of past predictions listed right next to it?
No, that's a great point. Yeah.
Right? You just don't see it, and you don't see it for a reason. It's the same reason why your career services area told you if your GPA is below 3.0, don't put it on your resume, right? You know, that if it's not good, they're not going to show that, right? And so it's a reminder that these experts, and by the way, they all have good convictions, selling reasons for why you should believe them. But at the end of the day, they get paid for having an opinion, not paid for being right.
Yeah. One of the last questions I had was, we've got a couple more here, you know, what advice do you give to investors when it comes to, man, I look at my accounts every day, I look at my portfolios every day, or I look at them every week. What on the frequency of looking at their accounts?
Yeah, Scott. In general, the research has shown that less is more. So I wrote a piece about this back in 2018, and certainly can share it with your clients if they'd like to see it. I love giving blood, but there's a reason why I'm not a doctor, because when they put that needle in my arm, I have to look away.
Yeah.
Right. I know the benefits to people and feeling good for helping others is numerous, and which is why I do it. But I know that if I watch that needle go in, I'm going to be less inclined to give blood. Right. And so they've shown that when you look at your portfolios, they actually did a study that showed if you look at portfolios, one group looked at the portfolios, it was every 6 months, and the other group looked at their portfolios monthly. And at the end of that time frame, the people that looked at their portfolios monthly had a much more conservative portfolio, a lot less stocks and a lot more bonds than the group that only looked at their portfolio twice a year. The reason for that is loss aversion, right? Which is we feel the pain of losses twice as much as we feel the joy of gains.
Wow.
And so it stands to be logical. The more times we look at our portfolio, the more chances we have to see losses, which in turn gives us an increased chance of saying, I'm uncomfortable, let's ratchet down the risk.
Yeah.
Which has a considerable impact in your ability to manage, for first of all, to achieve your financial goals, and second of all, to have a balance of stocks and bonds that's appropriate for your own financial plan.
Any final thoughts? Anything else you'd like to share today? Anything else that you're thinking about?
Yeah, Scott, I think one thing that I really would like to impart on the audience is that a reminder of during these times, like this is why you hire Scott, right? Is to build a financial plan, so that to make sure that you're prepared for inevitable downturns like this. So don't ask questions as to when the market will bottom, how low will it go, because no one knows the answer to those questions. But ask the questions that matter the most to you. Hey, Scott, does my plan still work, right? Remember, at the end of the day, we are all investors because we have dreams of what we want to do with that money, right?
Yeah.
I've thought about that a lot more in the last 2 months than I have before. Is I love traveling, right? I want to be able to go and travel, right? So whether it's traveling or whether it's having a second house or whether it's retiring early, the reason why we invest is so that we can achieve our financial goals.
Yeah.
And so asking the right questions is, does my plan still work? That's ultimately what matters the most. And also, did we, as part of our plan, Scott, did we plan for downturns like this, right? Because that's another part of that question that you want to know. Did my plan consider these types of situations? And so by asking those types of questions, you have a better ability to have a confidence around what your ultimate goals are and what's most important in your life.
Hey, John, we've had a question come in on the chat, and if anybody else wants to send us a quick question on the chat, go ahead. The question is, I feel this coronavirus is likely to reappear in the future. Are my dividends secure?
Yeah. So I think two different concerns there, right? One is, will the coronavirus reappear? And I think when you start reopening the economy, and by the way, I'm not an epidemiologist, so you take it with a grain of salt, but I think we're going to see the number of cases rise. But the question is, are they going to rise to a point where the economy has to shut back down, or that it causes grave concern to the overall economy, right?
Yeah.
And personally, I think the biggest indicators are we gonna maintain social distancing even as the economy opens back up?
Yeah.
Do we have enough testing so that people know that they have it sooner, so that they don't infect more people?
Yeah.
And how does the treatment and vaccine process, how is that progress occurring, right?
Yeah.
And so at least from what I've seen, I think there's reasons for optimism that even if the cases do climb when we reopen, that can be contained and that people will be vigilant about what they need to do to protect themselves. But certainly that is a risk that comes with reopening the economy.
Yeah.
As it pertains to the safety of their dividends, I think, again, when you're talking about stocks, any company can slash their dividend if they have to, right? If they have to preserve the company's well-being. So I think it's important to realize that no dividend is ever guaranteed to be safe. But again, I think also, and I can't speak to the stocks that you own, but one of the benefits of owning dividends from long, well-established companies that have a long track record of dividend payment and raising their dividends is there's a certain level of stability that should give you a higher level of confidence that those dividend payments will still be made. Yeah. But again, the emphasis is on higher level of confidence, but not certainty.
Yeah. Yeah.
Got anything to add there?
No, I think that's a great point. And I think that in regards to the dividend stock model and things like that, I know one of the things that's kept in mind with all of you guys at the think tank is what the payout ratio is. And the payout ratio is simply the ability to pay those dividends. So I think I think there is a higher confidence that those will continue to be paid out, but there's no guarantees, right? So I think anything along those lines that you want to talk to?
Yeah, Scott, as you said, the dividend stock model, I think, again, Brad focuses on sustainability, right? Is finding those companies that have a sustainable track record of maintaining their dividend. Because if they're constantly slashing their dividend, it doesn't give you much confidence in the ability of that income stream, right? And the other benefit, if we're talking about the dividend stock model, is diversification, right? There's between 25 and 30 stocks in that basket at all times, which means you're not relying upon one singular company for the income stream that you're getting from that portfolio.
Yeah, absolutely. John, I'm gonna throw you another question. I think you're gonna knock it out of the park, but this is totally something we hadn't got in advance, but I just thought of it as we were talking today, and it might come up. But as far as I've heard somewhat, well, man, the government's put all this money back into the system. The Fed's starting up maybe QE again. What are your thoughts or concerns about inflation, or yes or no? Any thoughts there as far as inflation and things to speak to on that?
Yeah, it's funny you asked about that, Scott, because I'm actually working on a client piece that I hope to be available later this week, because that's one of the questions I've been getting a lot on calls with clients, right? And I think it's important to look at two different perspectives. One is a short run versus the long run. In the short run, I don't think there's really any concern for inflation because right now there's not enough consumption. There's not enough demand, right? That's in fact why the government has responded with a stimulus plan, is to support demand. And we know inflation comes from when there's too many people chasing the same goods, right? There's high demand. Right now there's low demand. So right now, and the numbers last week came out, the core inflation, which excludes food and energy to make it less volatile, was at 1.4%, where the Fed has targeted 2%. So it suggests, again, in the near term, inflation is not a concern. In the long term, it's, that risk is elevated because of all the fiscal spending, right? Because of the elevated deficit that we're seeing. But I think it's important to realize you can't choose to not put the fire in your house out because you're worried about smoke damage. Yeah. Right? If there's a fire, you have to put the fire out and then worry about the smoke damage. And so with the Fed cutting rates to zero and providing other accommodations, and the government issuing $2.8 trillion in stimulus, what they learned from the 2008 and 9 recession was the stimulus was a lot smaller and done incrementally over time. And so what they found is that they believe it prolonged the recession and the time frame until we saw recovery. And so that's why you've seen both aisles, a bipartisan agreement to get this stimulus, a much larger stimulus package, into people's hands much sooner, because they realize that has the best chance of getting people back on their feet sooner. And we know that the sooner the people get back on their feet, the sooner they can start spending again and reboost the economy. And higher economic growth results in higher tax revenues, which should help support paying down some of that debt. The last thing I'll mention, Scott, is on that inflation front, the Fed's job is, if we start to see inflation pick up, the Fed's job is also to reduce stimulus, right? And they do that one of many ways, but one of the biggest ways that people see is by raising rates, right? Right now, the Fed, the interest rate's at 0%. Well, if inflation starts to creep higher, you can expect the Fed to increase their rates right, to help keep inflation in check. And certainly, if we, in most scenarios, if inflation is picking up, it's because the economy is doing better, and that means the government also, if it will be in a better position to service those debt payments. Yeah. And one more thing I mention on that topic is, when you look at interest rates, the 10-year Treasury is at 0.7%, and the 30 years at 1.4%. The cost of servicing all of this debt is at historical lows. We've never seen these types of lows, which means the cost of servicing this debt on an annual basis is on a percentage relative to the U.S. GDP is microscopic. And so this issue would be much more concerning if we were borrowing at 5 and 6%, but we're also borrowing right now at 70 basis points and 1.4%.
Yeah, that's great. John, I wanted to leave everybody, it's great this call today, a couple takeaways maybe to think about. One of those we kind of already dove into a little bit, and that's just look at your house, look at any large debt you have, and does it make sense to refinance that? Something to look at. Check with your banker, check with your lender. If you need our help with that, we can certainly put you in touch with people as well, but something to think about there. I think too, you made a great point about going to cash, right? We have to time the market 2 different times. We have to time the market when we get out, and we have to time the market. The harder time is getting back in. And I've had that discussion with clients, over the last couple of years, as well as we've talked about things like that. I think that when I've had that discussion, clients say, well, the recession is coming, I just don't know when. And we talk about, well, what are you going to do, Scott, when that happens? And, oftentimes my answer is, well, probably nothing, right? And at first that kind of catches people off guard, and you say, well, nothing. Why would you do nothing? And so then we talk about that. We talk about, well, when are we going to get out? And then the harder question is getting back in, because when we should get in, it's going to be the most painful time to get back in, right? So I think that whole conversation about just the going to cash, which is we're trying to time the market in and time the market out and then time it back in. And then the third point I was going to make too is just focusing on your plan, right? So if you have questions, am I still okay? What's going on? I see my investment accounts. I got that statement from March. It was down a lot. I got the statement from April. It was better. Where are we at? Let's just talk about it. You can call me, you can email me, we can discuss your plan, see where you're at, see what's going on, and go through that. So I think those are some of the takeaways I took today. And I'll, hand it back to you. Any other thoughts or comments to wrap it up?
Yeah, Scott, first I would just say, for all of you who held in over the past 3 months, you deserve a pat on the back. You should commend yourself. Yeah. Too often we think about what we don't have. And I think these kind of times remind us it's important to have gratitude, right? And for those of you who had the cast iron stomach to hold, you held through the fastest decline to a bear market in history. And you've already been rewarded to that to a certain extent with that turnaround that we've seen. And so I think it's important that you give yourself that recognition for staying the course. Yeah. Because of that benefit that you've seen now, and the benefit that you should continue to see as a long-term investor. The final thing I'll say, and it's a little bit quirky, but I think it's so important, is think about your portfolio and watching these headlines, is to let the headlines of your lives dictate your decisions, not the headlines of the news. Yeah. Right? Is focus on changes to your, if you want to make changes to your portfolio, what about your time horizon or risk tolerance or objectives has changed to trigger that, right? That's right. And understand that the headlines of your lives are much more important to your overall investment process and your financial plan than the headlines on any given day in the news. That's great.
Well, I appreciate everybody's time today. I appreciate everyone taking time to log in and see everything and see John's questions, and we go through that, and the questions that, as he answered the questions you guys had sent in. So again, anything else you guys need, reach out to me. We'll go through that. We can do it by Zoom call. We can do it by phone call. We can go through stuff. So happy to help as always. And I appreciate everyone's time and patience today. Thanks so much, guys.
Be well.